Okay. So you want to buy a gold mine. Not a few gold coins. Not a gold ETF sitting quietly in your investment account. An actual gold mine. The kind with miles of underground tunnels, fleets of 100-ton haul trucks, processing plants the size of shopping malls, and enough buried metal to make headlines around the world. It sounds like the ultimate investment. After all, gold has been the universal symbol of wealth for thousands of years. Central banks buy it. Billionaires store it. Investors rush toward it whenever the economy feels uncertain. So owning the place where gold comes from should be the closest thing to owning a machine that prints money. Except that's almost never how it works. Because here's the strange part. Some of the richest looking gold mines on Earth have destroyed billions of dollars in shareholder value. Companies have spent years discovering massive deposits, only to lose money after production finally began. Others have watched their stock prices collapse while gold itself was climbing to record highs. So how is that possible? How can a business built on selling one of the world's most valuable metals still struggle to make a profit? The answer begins with one simple misunderstanding. Most people think a gold mine sells gold. In reality, a gold mine sells certainty. And certainty is the rarest resource in the entire business. Before a single gold bar ever leaves the refinery, everything starts with probabilities. Geologists estimate where the gold might be. Engineers estimate how much can actually be recovered. Economists estimate future operating costs. Executives estimate what gold prices might look like 5, 10, or even 20 years from now. Every major decision is based on information that is never completely certain. That means when you buy a gold mine, you're not buying stacks of gold waiting underground. You're buying millions of tons of rock that may or may not produce enough profitable ounces to justify the billions of dollars required to dig them out. And that's where the illusion begins to fall apart. A mountain containing millions of ounces of gold may look priceless on paper. But until those ounces can be extracted safely, processed efficiently, transported economically, and sold for more than they cost to produce, they're simply numbers inside a geological report. That's why experienced mining investors rarely ask how much gold a company owns. They ask a completely different question. How much does each ounce actually cost to produce? Because buried gold has no market value by itself. Only profitable production does. And that single difference separates successful mining companies from businesses that quietly disappear after spending billions chasing what look like an obvious fortune. But before anyone can calculate a single ounce of profit, there's another system hiding underneath everything, one that's far more expensive, far more complicated, and surprisingly has almost nothing to do with gold itself. The first surprise waiting for every future mine owner is that finding gold is usually the cheapest part of the entire business. Turning that discovery into a functioning operation is where the real financial machine begins. Imagine that your exploration team has finally confirmed a deposit containing several million ounces of recoverable gold. Headlines celebrate the discovery. Investors become excited. The market value of your company climbs overnight. But nothing has actually changed underground. The gold has not moved an inch. It is still trapped inside solid rock, exactly where it has been for millions of years. The only thing that has changed is that the market now believes it might eventually become profitable. That belief is valuable, but it is not cash flow. Before the first truck ever leaves the site, you must build an entirely new industrial ecosystem in a place that often has almost no infrastructure at all. Many of the world's largest gold deposits sit far from major cities, hidden beneath deserts, mountains, forests, or frozen landscapes. That means roads have to be built. Power has to reach the site. Water systems have to be developed. Housing for hundreds or even thousands of workers must be constructed. Heavy equipment worth hundreds of millions of dollars must be delivered to locations that may not even have paved highways. Every piece of machinery, every gallon of diesel fuel, every replacement part, and every shipment of food becomes part of the operating equation. Suddenly, you are not running a gold business anymore. You are managing a remote industrial city that happens to produce gold. Then comes the permitting process, and this is where time quietly becomes one of your largest expenses. Environmental studies can take years. Engineering reviews continue while designs evolve. Financial institutions analyze whether the project can survive lower gold prices. Governments review regulations. Local communities negotiate long-term agreements. Every month that passes without production means salaries continue, consultants continue, equipment financing continues, and investors continue waiting for a return that does not yet exist. Some projects spend more than a decade moving from discovery to commercial production. During that entire period, the mine earns almost nothing while expenses continue to accumulate. This creates another paradox. The larger the project becomes, the greater the financial pressure before a single ounce is sold. A billion-dollar mine does not simply require more capital. It also requires far greater confidence that future gold prices, operating costs, and production targets will all remain favorable for many years. Even a small forecasting error can completely reshape the economics of the project. A diesel price increase, lower than expected, or grades, slower equipment performance, or higher labor costs may seem manageable individually. Together, they can erase the profit margin that looked so convincing inside the original feasibility study. That is why experienced mining executives often spend more time studying costs than studying gold itself. Gold rarely surprises anyone. Operating expenses do. And hidden beneath every successful mine is an enormous financial structure that must remain stable long before the first gold bar ever leaves the refinery. But even after all of that money has been spent and every permit has finally been approved, the most important question still has not been answered. How do you actually turn ordinary rock into something valuable enough to justify everything you have invested? The transformation begins inside the processing plant, because this is where an ordinary truckload of rock either becomes a profitable shipment or an expensive mistake. Stand next to a haul truck carrying 200 tons of freshly mined material and you might assume you are looking at a fortune. In reality, that entire load may contain only a few ounces of gold. Everything else is simply rock that must be moved, crushed, ground, treated, filtered, and discarded before those few valuable ounces can finally emerge. That is why experienced mining engineers rarely talk about gold first. They talk about grade. Grade measures how much gold exists inside each ton of ore, often expressed in grams per metric ton, and even a tiny difference can completely transform the economics of a mine. A deposit averaging 1 gram per metric ton may require processing enormous volumes of material every single day just to remain profitable. Increase that average to 2 grams, and the financial picture changes dramatically. Lower it slightly, and millions of dollars in expected profit can disappear almost overnight. But grade alone is still not enough. The next challenge is recovery. Not every ounce trapped inside the rock can actually be extracted. Some remains locked inside minerals that current technology cannot recover economically. Others are lost during processing despite sophisticated equipment. A mine may report 5 million ounces of contained gold, yet only a portion of that total may ever become finished bullion. Suddenly, the business becomes less about finding gold and more about maximizing efficiency. Every conveyor belt, every crusher, every grinding mill, every chemical circuit, every filtration system, and every refinery stage exists for one purpose: recover one more percentage point. Because a recovery improvement that sounds insignificant in a laboratory can translate into hundreds of thousands of additional ounces over the life of a major operation. Now imagine this system operating 24 hours a day, 7 days a week. Electricity powers enormous motors without interruption. Water continuously circulates through the plant. Maintenance crews inspect equipment before small problems become costly shutdowns. Laboratory technicians constantly test ore quality because the composition of the rock can change from one section of the mine to another. If recovery begins slipping by only a small margin, managers need answers immediately. Was the ore different? Did equipment performance decline? Did operating conditions shift? Every percentage point becomes another financial decision. This creates another paradox that surprises most people. A successful gold mine is not judged by how much gold it discovers. It is judged by how consistently it converts unpredictable geology into predictable production. Investors reward reliability almost as much as they reward size because predictable output supports predictable cash flow. A mine producing fewer ounces than expected can disappoint the market even while gold prices remain historically strong. Meanwhile, another operation with smaller reserves but exceptional efficiency may quietly generate stronger long-term returns. That is why the processing plant is often described as the heart of the operation. It does not create gold. It creates confidence that the enormous industrial system surrounding it can continue producing profitable ounces day after day, year after year. But even the most efficient operation still depends on one variable that nobody inside the mine can control, and that single variable has rewritten the fortunes of entire mining companies more times than almost any machine ever could. That variable is the gold price, and unlike your processing plant, your equipment, or your operating strategy, it answers to nobody inside the company. Every morning the market opens, the value of every ounce still buried beneath your property quietly changes without a single employee touching a machine. If the price rises, investors often assume your business automatically becomes more profitable. Sometimes they are right. Sometimes they are completely wrong. Imagine your mine produces 300,000 ounces each year. A $100 increase in the market price of gold appears to create an additional $30 million in annual revenue. On paper, the opportunity looks obvious. But the market rarely moves in isolation. Rising gold prices are often accompanied by higher fuel costs, more expensive steel, increasing wages, tighter equipment availability, and inflation across nearly every service your operation depends on. The same economic conditions that make gold more valuable can also make every ounce significantly more expensive to produce. Suddenly, the extra revenue that looked guaranteed begins disappearing into a growing list of operating expenses. This is why mining executives spend enormous amounts of time focusing on a number that most people have never heard of. It is called the all-in sustaining cost, often shortened to AISC throughout the industry. This figure attempts to capture the complete cost of producing each ounce while keeping the mine operating over the long term. It includes mining, processing, maintenance, administration, replacement equipment, ongoing development, and many other expenses that never appear in the headlines. Investors compare this number directly against the market price of gold because the difference between the two determines the real operating margin. A company producing gold at $1,300 per ounce enjoys a very different future than one producing at $1,900, even if both sell into exactly the same market. That creates another paradox. The company with the largest gold reserve is not necessarily the most valuable investment. The company with the healthiest margin often earns greater confidence because it has room to survive unexpected shocks. If prices decline, efficient operations continue generating cash while high-cost producers suddenly find themselves under pressure. This explains why experienced investors rarely celebrate high gold prices by themselves. Instead, they ask a more important question. What happens if prices fall tomorrow? A mine designed only for perfect market conditions is a fragile business. One designed to remain profitable across multiple commodity cycles becomes a durable one. That philosophy influences nearly every major decision, from expansion plans to financing. Strategy. Some companies even lock in future selling prices through hedging contracts to reduce uncertainty, sacrificing part of the upside in exchange for more predictable cash flow. Others accept full exposure to market swings, hoping stronger prices will reward shareholders over time. Neither approach guarantees success because both involve balancing opportunity against stability. In the end, the market does not reward the company that dreams about the highest possible gold price. It rewards the one that can continue operating when reality refuses to cooperate. And that reality extends far beyond economics, because the next challenge is not buried underground or traded on financial markets. It comes from the people, governments, and institutions that ultimately decide whether your mine is allowed to keep operating at all. The moment a mine begins operating, it enters a relationship that is every bit as important as geology or engineering. That relationship is with the people and institutions surrounding it. Unlike a factory that can often relocate production, a gold mine has only one address. Your body cannot be moved, which means the business must adapt to the country, the regulations, the local workforce, and the communities that exist around it. This creates another reality that surprises first-time investors. A mining company does not simply extract resources. It operates under a long-term social agreement that must be maintained year after year. Governments expect taxes and royalties. Local businesses expect economic activity. Employees expect stable careers. Investors expect growing returns. Environmental regulators expect strict compliance. Every one of these expectations competes for the same stream of cash generated by each ounce of gold. The more successful the mine becomes, the more attention it attracts from every stakeholder connected to the project. This is why experienced executives often describe mining as a business built on relationships rather than equipment. A modern operation may own the latest processing technology and the most efficient fleet in the industry, yet still struggle if it cannot maintain confidence with the institutions that oversee its future. Long before expansion begins, companies spend years negotiating land access, infrastructure improvements, water management plans, and long-term operating commitments. Those conversations continue throughout the entire life of the mine because circumstances never remain constant. Economic priorities evolve. Regulations are updated. Infrastructure requirements grow. New discoveries change development plans. Every adjustment requires cooperation rather than assumption. This produces another paradox. The most valuable asset inside the company is not always the deposit itself. It is often the stability that allows the deposit to be developed over decades instead of years. Investors place enormous value on predictable operating environments because predictability lowers financial risk. Two mines with similar reserves and identical production forecasts can receive dramatically different market valuations simply because one operates in a more stable regulatory environment. That difference influences borrowing costs, expansion opportunities, and shareholder confidence long before another ounce is produced. Meanwhile, management must balance decisions that extend far beyond quarterly earnings. Should cash be distributed to investors or reinvested into extending the life of the operation? Should production increase rapidly, or should higher-grade sections be preserved for future years? Should exploration continue beyond the current reserve, or should capital be directed toward improving existing infrastructure? Every answer affects not only next year's financial results but the long-term future of the entire operation. In reality, the mine is no longer just extracting gold. It is constantly allocating trust, capital, and time across multiple competing priorities. That balancing act is what separates a short-lived opportunity from a business capable of operating for decades. Yet despite careful planning, disciplined management, and favorable market conditions, every mine continues moving toward one unavoidable reality. The resource beneath the ground is finite. Every truckload of ore processed today permanently reduces what remains for tomorrow. From the very first day of production, the operation begins a race against depletion, and that race ultimately determines whether the mine creates lasting value or slowly runs out of the one thing it was built to produce. Every mine eventually reaches the point where the easiest gold has already been recovered. From that moment forward, management is no longer asking how much gold remains underground. They are asking how much profitable gold remains. Those two numbers are rarely the same. A deposit may still contain millions of ounces, yet if extracting the remaining material costs more than the market is willing to pay, those ounces effectively stop being part of the business. They still exist beneath the surface, but economically they have disappeared. This is why reserve life becomes one of the most closely watched measurements in the entire industry. Every year, the mine removes part of its future inventory. Exploration teams work continuously to replace what production consumes, almost like trying to refill a reservoir while water is constantly flowing out. Sometimes they succeed by extending known ore bodies or discovering entirely new zones near existing operations. Sometimes years of drilling produce very little, and the countdown quietly continues. That creates another paradox. A mine can report strong profits today while becoming less valuable tomorrow if it fails to replace its reserves. Investors understand this better than almost anyone because they are not buying this year's production alone. They are buying the expectation that profitable production will continue for many years into the future. This explains why exploration budgets rarely disappear, even during periods of healthy earnings. Spending millions of dollars searching for additional resources may look expensive, but allowing reserve life to shrink can become even more costly. A successful discovery extends the economic life of processing plants, infrastructure, equipment, and skilled workforces that already exist. Without new reserves, those same assets gradually lose value as the remaining mine life becomes shorter. Meanwhile, management faces another difficult decision. Should the highest grade ore be mined first to maximize short-term profits, or should production be balanced to extend the operation over decades? Mining the richest sections immediately may produce impressive financial results today, but it can leave lower quality material for later years, increasing future costs. Taking a more disciplined approach may reduce today's earnings while creating a healthier business over the long run. Neither strategy is automatically correct because every deposit has its own geology, operating costs, financing obligations, and market conditions. The entire operation becomes an exercise in managing time as carefully as money. Every production schedule, every exploration campaign, every equipment purchase, and every expansion project is ultimately designed to answer one question. How do you create the greatest long-term value before the resource is exhausted? This is why experienced executives often describe mining as the business of converting finite assets into durable cash flow. The gold itself is limited, but the value created from responsible planning can last far beyond the final shipment. Yet even the best planning cannot eliminate every risk. A discovery may disappoint. Costs may increase unexpectedly. Commodity markets may weaken. New regulations may reshape the economics of the project. The closer the operation moves toward the end of its reserve life, the more important every decision becomes. Because in the mining industry, failure rarely arrives in a single dramatic moment. More often, it appears gradually, through small changes that compound over time until the system that once looked extraordinarily profitable can no longer sustain itself. That slow decline is exactly why the strongest mining companies think differently from the rest of the market. They know that a gold mine is not simply a collection of equipment sitting above a valuable deposit. It is a constantly evolving system where geology, engineering, finance, regulation, and human decision-making interact every single day. Remove one of those elements, and the entire structure begins losing stability. This becomes especially clear during periods when the industry appears to be thriving. Rising gold prices often encourage companies to expand production, purchase new assets, or acquire neighboring projects. At first, those decisions seem logical. Higher prices create higher cash flow, and higher cash flow appears to justify faster growth. But history has repeatedly shown that the most dangerous time to make long-term commitments is often when the market feels most optimistic. Expansion increases complexity. New equipment requires additional maintenance. Larger operations demand more experienced managers. Additional processing capacity raises energy consumption. Acquired projects introduce unfamiliar geology and different operating conditions. Every layer of growth creates another layer of coordination that must continue functioning even after market conditions change. This is another paradox hidden inside the mining business. Growth does not automatically reduce risk. In many cases, it multiplies it. A company operating one highly efficient mine may outperform another managing several average operations because simplicity can be remarkably valuable when uncertainty increases. This is why disciplined capital allocation becomes one of the industry's greatest competitive advantages. Successful executives often reject projects that appear attractive simply because the long-term economics are not compelling enough. They understand that every dollar invested today carries an opportunity cost that may not become visible for years. Should capital fund a new processing circuit, extend an existing pit, explore nearby land, reduce outstanding debt, or be returned to shareholders? Every decision changes the future shape of the business. Investors watching quarterly earnings may focus on production growth, but experienced operators pay equal attention to resilience. They ask whether the company could continue operating if fuel prices rose sharply, if ore grades declined unexpectedly, or if gold prices entered a prolonged period of weakness. A mine that survives only under ideal conditions is not truly efficient. It is simply fortunate. The strongest operations are designed with enough flexibility to absorb setbacks without compromising. Their long-term strategy. That resilience comes from thousands of small decisions rather than one dramatic breakthrough. Better maintenance schedules reduce costly downtime. More accurate geological models improve production planning. Smarter water management lowers operating expenses. Incremental improvements in recovery increase revenue without expanding the mine itself. None of these changes attract major headlines, yet together they create the durable competitive advantages that separate exceptional operators from average ones. In the end, the business becomes less about discovering extraordinary opportunities and more about executing ordinary decisions with extraordinary consistency. That quiet discipline is rarely visible from the outside because most people only notice the final gold bars leaving the refinery. They never see the countless financial, operational, and strategic choices required to make those shipments possible. And when even one of those hidden systems begins to weaken, the effects usually appear long before anyone outside the company realizes that the real challenge has already begun. The warning signs rarely arrive all at once. They appear quietly, hidden inside reports that most people never read. Recovery rates begin slipping by a fraction of a percent. Maintenance costs edge upward quarter after quarter. Or grades gradually decline as the richest sections become exhausted. Equipment remains operational, production continues, and gold bars still leave the refinery, making everything appear normal from the outside. Yet beneath that appearance, the economics of the operation are slowly changing. This is how many mining businesses enter their most dangerous phase. They are not failing because they suddenly run out of gold. They are failing because the system that once produced healthy margins is becoming steadily less efficient. At first, management can compensate. Higher throughput offsets lower grades. Additional drilling identifies small extensions to existing reserves. New technology improves recovery by another percentage point. Operating schedules become more efficient. Every adjustment buys a little more time. But each improvement also has limits. Eventually, the business reaches a point where every additional ounce requires disproportionately greater effort, greater investment, or greater operating cost. That creates another paradox. The mine may actually produce more gold than ever before while generating less value for its owners. Revenue continues flowing, but free cash flow begins shrinking as sustaining capital requirements increase. Aging equipment requires replacement. Waste rock must be moved farther to reach remaining ore. Processing circuits operate longer to recover the same amount of metal. Every solution introduces another expense. Financial markets usually recognize this transition before the general public does. Investors begin asking different questions. Instead of celebrating production records, they focus on reserve replacement, capital discipline, debt levels, and long-term margins. They understand that a mine producing impressive volumes today may already be consuming tomorrow's profitability. This shift in perspective separates speculation from ownership. Speculators often chase the excitement of rising gold prices. Owners study whether the entire operating system remains economically sustainable across the next decade. Sometimes companies attempt to solve these challenges through acquisitions, purchasing neighboring deposits or merging with competitors to extend production life. Occasionally those strategies succeed. Other times they simply postpone deeper structural problems by adding complexity instead of efficiency. The underlying challenge remains unchanged. Every mining operation must eventually answer the same question. Can future production generate enough value to justify future investment? If the answer becomes uncertain, access to financing becomes more difficult, expansion slows, exploration budgets shrink, and the business gradually loses flexibility. None of these developments happen overnight. They reinforce one another through a chain of small decisions and changing economic conditions. That is why experienced operators rarely describe mining as a business of dramatic victories or sudden failures. It is a business where long-term outcomes are shaped by countless incremental choices made over many years. The companies that endure are usually the ones that recognize these signals early, adapt before problems become obvious, and accept difficult decisions before circumstances force them to act. In the end, the greatest risk is not that the gold disappears. The greatest risk is believing the system will continue working exactly as it always has, even while every hidden variable beneath the surface is slowly changing. By now, the illusion has almost completely disappeared. What once looked like the simple ownership of a valuable resource has revealed itself as something far more complex. The gold was never the business. It was only the output of an enormous system that had to function with remarkable precision every single day. Every profitable ounce depended on thousands of interconnected decisions involving geology, engineering, finance, infrastructure, logistics, regulation, capital allocation, and long-term planning. Remove any one of those pieces, and the entire economic model begins to weaken. That is why the world's most successful mining companies rarely describe themselves as gold producers. In practice, they are managers of uncertainty. Every investment is made years before its results become visible. Every expansion assumes that future conditions will remain favorable enough to justify today's spending. Every reserve estimate is an informed prediction rather than an absolute certainty. Every production target is built upon countless variables that can change over the life of the mine. Yet despite all of that uncertainty, the operation must continue delivering consistent results to employees, investors, lenders, governments, suppliers, and local communities. This is the true challenge of ownership. It is not about discovering treasure. It is about maintaining confidence across an industrial system where almost every important variable changes over time. That explains why two companies operating deposits of similar size can experience completely different outcomes. One may generate decades of stable returns because management consistently protects margins, replaces reserves, controls capital spending, and adapts before problems become crises. Another may own an equally impressive resource but gradually lose flexibility through rising costs, declining grades, excessive expansion, or poor financial discipline. The difference is rarely the amount of gold beneath the ground. More often, it is the quality of the decisions made above it. This brings us back to the question that seemed so simple at the very beginning. What does it really mean to own a gold mine? It does not mean owning unlimited wealth buried beneath the earth. It means accepting responsibility for one of the most capital-intensive, operationally demanding, and economically uncertain industrial systems in the modern world. You are constantly converting probability into production, production into cash flow, and cash flow into future survival before the resource slowly disappears forever. That is the central paradox. A gold mine may contain billions of dollars in metal, yet its long-term success depends far less on the value of the gold than on the strength of the system built to recover it efficiently. In the end, the richest asset is not the deposit itself. It is the ability to keep the entire operation profitable through changing markets, changing geology, changing costs, and changing expectations over many decades. So the greatest lesson is not that gold creates wealth. The greatest lesson is that wealth is created by systems capable of transforming uncertainty into disciplined execution year after year. And once you understand that, you realize you never truly owned the gold. You owned the responsibility of keeping an extraordinarily complex machine alive long enough to turn buried rock into lasting economic value.